It's being called market mayhem. People around the world have seen the value of their investments plummet. Was the decision to downgrade the US economy from a AAA rating the catalyst? Or is it the Eurozone's debt crisis and fears of another recession that caused the markets to panic? Are global economies running out of options to rescue their economies? And what's next for stocks, the dollar and the global economy? This is Inside Story. Hello and welcome to Inside Story. I'm Stephen Cole. The turmoil came out of nowhere. Suddenly the markets were tumbling. It began in Asia. Europe followed soon afterwards. The DAX, the FTSE, the Dow all saw losses. The credit agency Standard & Poor had carried out its threat and cut the US credit rating. What followed was a rout that wiped out trillions of dollars from the value of global stock markets and have left world economies staggering and investors in a blind panic looking for safe havens. Fungi Nguyen explains.
Turmoil in financial markets. Over the past 3 weeks, the U.S. S&P 500 share index has fallen 14.7%, wiping $1.6 trillion off the value of investors' savings. The quiet hum of this financial crisis could be heard in late 2006 as more and more American homeowners defaulted on their mortgages. With the failure of Lehman Brothers in August 2008, the financial crisis became a roar. We continue to live through this crisis today. The path of U.S. shares tells the story of high volatility and low confidence on Wall Street. Follow the dramatic falls of the past 3 weeks, U.S. stock markets are back to their August 2008 low levels. 3 years of stagnation. In November of 2008, Lehman Brothers went bust with repercussions felt throughout the markets. By February 2009, the world was experiencing convulsions. Lending stopped and the economy fell into a deep recession. Governments bailed out banks to the tune of $750 billion. Add to that, Federal Reserve printed more money to inject into the economy. By mid-2010, the effects of the 2009 support package was fading. In August, the Federal Reserve indicated it would take further action, allowing markets to recover. The European sovereign crisis, already almost 2 years in the making, reared its ugly head, driving markets lower. By July, the volatility experienced over the last 3 weeks is the culmination of all these events. The 2008 crisis was the result of too much borrowing by households and banks. The solution was the transfer of this indebtedness to governments, but this did not work. Today, Western economies are barely avoiding recession. Unemployment is the highest it has been in nearly 2 decades, and governments have too much debt to be able to do anything meaningful. In addition, political wrangling has further eroded confidence, culminating in the default of Greece and Standard & Poor's downgrade of U.S. debt. Governments are paralyzed with no clear path to growth. As a result, markets are responding with uncertainty. And despite the waves of economic downturns, governments are still being looked to steer the economic ship to shore. Fungi Nguyen for Inside Story.
Well, joining us now to discuss the volatility are our guests in Los Angeles, Richard Eskow. Richard's a consultant and writer and a senior fellow of the Campaign for America's Future. In New York, Andrew Schiff, he's the Director of Communications at Euro Pacific Capital and author of How an Economy Grows and Why It Crashes. And in Singapore, Rajiv Biswas is the Asia Pacific Chief Economist for IHS Global Insight. Welcome, all of you. And some questions for all of you as well. Are global economies running out of time to heal themselves? Have world governments any policy levers left to rescue their economies from default and more market mayhem? Is what we are seeing a culmination of events that began with the failure of Lehman Brothers and went on to the European debt crisis and the US downgrading? Well, Andrew Schiff, one trader in South Korea, has thrown himself off a tall building in Seoul. Can anything be done to stop the global economies from doing likewise?
Well, unfortunately not. Probably there is a global, well, maybe not a global recession, but certainly a recession for those economies that have been addicted to debt over the past few years. Basically, what we believe we're seeing is the final innings, to use a baseball phrase, of a very long experiment that the world has conducted in fiat money. Up until 1971, the global monetary system was tied to the dollar, which was pegged to gold. But since 1971, that last link was severed, and we've been awash on a sea of printed money since then. Now, as your report suggested earlier, all of the bad private debt in 2008 was transferred to the governments around the world, who are now awash in debt. And we've tried to roll over that debt and pump in more liquidity and more liquidity. And we're playing out that system. You cannot base an economy on debt and printed money and borrowing and spending, which is what we've been trying to do. So now the economies around the world that are overly indebted are trying to deleverage. And deleveraging, which is necessary, will bring on a severe recession. The economies that are not in that situation, that are creditor nations, don't have those problems. Unfortunately, they've all bought into the same global system and are trying to support the falling U.S. dollar. So,
okay, Andrew.
The bad economies are bringing down the good economies.
Okay, you're saying we're heading straight away to a recession. Richard Eskow, we have ironically seen a slight recovery, haven't we? Oil and equities up, even the euro improved against the dollar. It seems that it doesn't take much for even a slight restoration of confidence.
Well, I think what that's showing us is just how confused the markets are right now, just how reactive and sensitive they are. And I think that, let's remember this latest downturn didn't begin with the downgrade of the U.S. Federal government. It began when Congress and the president were unable to come up with an aggressive plan for increasing government revenue or for providing meaningful relief. I don't think the problem is government spending per se. We're not at abnormally high levels of government borrowing considering the situation. We run that risk in the future. I think what the markets are reacting to is the fact that the government has been pumping money in the wrong places because it hasn't led to increased borrowing or increased consumer spending. So consumers don't have confidence in their economy and aren't able to spend with confidence. High unemployment is interfering with growth. I think that's what the markets are reacting to.
But Richard, it's a very simple problem. Isn't the problem that the American government has spent too much money?
No, I don't think so. I think it's spent it in the wrong way. I think it hasn't collected enough money. That's an enormous part of the problem.
Oh, well, that's a political problem.
I think it's also spent it in excess. It's all a political problem. Spending is a political problem, yes. As well as collecting. So the fact that it's not having adequate levels of revenue, the fact that it's not doing any kind of short-term program to increase hiring or spur economic growth, I think is key to all of this.
All right, well, we'll come to Andrew for an answer to that in a moment, but I want to go to Rajiv Biswas, who's in Singapore. One of the safe havens has traditionally been Asia, certainly ASEAN. A lot of people are looking at ASEAN. The markets clearly reacting to a very fragile US economy. Where are the safe havens for Asian investors, Rajiv?
Well, I think we are seeing a divided world. We're seeing problems in the North Atlantic economies, in the US and Europe. And of course, these are still the largest economic regions of the world. So Asia is very concerned about the transmission effects through trade and investment flows on their own export-driven economies. And that's why we're seeing that despite the strength of Asian economies right now and much less imbalances in their own economies, that even Asian investors are sort of moving out of equities because they're fearing the earnings outlook and have been shifting into gold, yen and Swiss franc as safe haven currencies. And of course, in the last few days, in the last week, when we saw the real big turmoil and fear in global financial markets, indeed, despite the downgrade of the US economy by S&P, of US sovereign debt, we still saw a big shift out of equities into US government debt. So US Treasuries was still one of the major safe havens where investors from central banks and other parts of the economy put their money. And I think if we look at what central banks in Asia have been doing, they have been trying to diversify their holdings into other currencies out of the US dollar, but there's very limited scope to do that. There has been some buying of gold by some of the central banks, the Bank of Korea, Bank of Thailand, and also the Indian Central Bank have been buying greater gold reserves in the last 12 months.
Rajiv, I wonder whether Washington, America, could learn a lot from Asian currencies and Asian banking practices.
Well, this is the irony that, Asia went through the East Asian crisis and got a lot of lessons from the US and Europe about how to manage their own economies. They heeded those lessons. They've reformed their banking sectors and reduced non-performing loans, reduced, the government debt levels very considerably and built up their foreign exchange reserves. So now they're in far better shape. But at the same time, we've seen that the US and European economies haven't heeded the lessons that they were giving to Asia and have gone down the same road of creating very great imbalances in their own financial systems in the last 10 years. And in particular, in terms of how they've handled lending for mortgages and so on, which was one of the problems in the East Asian crisis.
Who's responsible, Andrew, for those imbalances? And they're clear imbalances, aren't they?
Yes, we have a perpetuation of we have a situation where a lot of the emerging economies, particularly China, had as its policy an export-driven economy that required a consistent peg with the U.S. dollar to maintain stability. And as a result, the dollar has tried to fall over the last few years because we're not a productive economy. We borrow and spend far too much. I mean, ironically, everyone acknowledges that we got into this crisis in the first place because American consumers borrowed and spent too much. Now the left, some of your an earlier comment said we can get out of it by having the government borrow and spend more, and that just doesn't make any sense. And certainly raising taxes is no way to spur growth. But in order to maintain that peg between the strengthening Asian currencies and the falling Western currencies has created huge imbalances in the global economy, where one sector essentially produces and saves the East, and the other sector, the West, borrows and spends, and that's simply not sustainable. And we're seeing the final innings of that right now.
Richard Eskow, we talked about economics being linked to politics, and there was a lot of politics, I think, in the S&P decision because it was reflecting, perhaps, if you like, a criticism of the American institutions, which they say have weakened at a time of fiscal challenge. But after all, the S&P verdict, that's just an opinion, isn't it? It hasn't changed anything.
Well, it's an opinion, and it's a dubious opinion given the S&P's own history of changing its mind about the subject of government debt. Even over the last 6 months, it's zigged and zagged about what it thinks is appropriate. The other rating agencies haven't gone along with it. There's been a lot of question about their decision-making process. They gave their highest rating to some of the worst mortgage-backed securities we've ever seen in history. And so, yes, I think there's a lot of politics behind it. And I'd also just like to add that it appears that Mr. Schiff and I disagree about some things, but we have clear models from experience about what happens when we cut tax rates so deeply for the highest earners as we've done and don't see any jobs produced from it versus when we see recessions or crises like the ones we're experiencing now and have spending and investment to reverse that. We've seen it over and over. There are historical patterns.
Tax rates are down, but loopholes are closed.
We know what we need to do.
All right, sort of, Andrew, coming in.
The top earners in this country pay just as much. Yes, they do. Yes, they do. That's a complete canard. The rates have come down from the 50s and 60s, but all the loopholes are closed. In terms of, except for the hedge fund people who pay capital gains on their income, which is a policy that I do not agree. Tax rates, in terms of taxes paid by people in the productive class in the 200,000 to 1 million range, are just as high, if not higher, if they've ever been. And 47% of taxpayers in this country don't pay federal income tax, and you should know that.
Okay, I want to broaden it.
Well, first of all, I don't think that's correct. And secondly, that 47% of people pay sales tax and other forms of tax. So these are all talking points, but they're not.
I said income tax. I said income tax.
Tax is an issue.
I said income tax.
Tax is a big issue. Same as a political issue. Same as interest rates is normally the only economist weapon. But I want to broaden this from American taxes to globally and go to Rajiv. Markets have been acting irrationally. In fact, there's been carnage, as we all know. There's been just a sea of red lots. The Dow down 5.5%. Brazil, one of sort of the emerging economies and a powerful economy, down 8%. We talk about an Arab Spring contagion Rajiv. Is there a global market contagion?
Well, I think these things, we do see such episodes when you're having a major adjustment of view. And although you said that, it's irrational, I think the foundations for the readjustment of portfolios, the way it started was rational, because we had a big readjustment of the first half US growth data, which, was a big surprise for markets. They realized that the US growth outlook was much weaker than had previously been understood. And of course, what came into focus also last week was the very large US deficit, spending cuts that will happen over the next decade. So I think global investors reacted to that news that, the US is much weaker than they had expected, and the outlook is also weak. So therefore, portfolios have adjusted away from equities into the safe haven assets, and they've continued to, view the US dollar as a very risky asset, I would say, in terms of the outlook. That's why we're seeing money flowing into gold and Swiss franc and yen.
And yen,
of course,
exactly.
what we haven't talked about very much is the European situation on
I'll
top
come
of all
on to-
that.
I'll come
where
on
we've
to-
also been seeing weakening growth.
Exactly. I'll come on to Europe in just a second. But I want to ask Richard and Andrew, not at great length, please, gentlemen. We've talked about the markets which are impersonal and they are remote for the vast majority of people. But what impact do they have on ordinary people's lives, on people's mortgages, pensions, life insurance, their jobs? Richard first.
Well, of course, jobs are big. I mean, I think, market confidence can lead to increased spending, consumer confidence. Right now, a lot of corporations don't feel there's a market for their goods and services, so they're not hiring. That's why U.S. corporations are sitting on $2 trillion in cash. So that lack of confidence translates into lack of jobs. And of course, market fluctuations also affect, as you said, credit card rates, mortgage rates, a lot of personal cost of debt.
Andrew, is it all negative?
One of the things that happened yesterday that people aren't talking about, with the Fed saying they're going to hold interest rates near zero for the next 2 years, I mean, that decimates people on fixed income. You cannot get any kind of rate of return on savings deposits anymore. You add to the fact that running $1.5 trillion a year in deficits and growing, the United States has to depreciate the dollar in order to pay its bills. So we're going to be seeing a lot of inflation, a lot of erosion in purchasing power, no interest available to seniors. So it certainly puts a very serious strain on people depending on fixed income. And I think the fall in the markets just simply underscore that we've been living in a phony economy. We've been trying to borrow our way to prosperity, and that can't work. And people are starting to understand that, and they're confused and scared.
They certainly, Rajiv, understand that in China, don't they? Unusually undiplomatic, unusually critical of Washington. What is China's role now? Is it pulling its weight? It's got so much of the US reserves in its basement, $3 trillion or something like that. Can it make a play here? Can it add or stabilize the markets?
Well, of course, in the short term, it has that ability, but whether it wishes to do that's another question. But I think the key question about China is that firstly, it's going to become the world's largest economy in the next decade. And secondly, the imbalances that we see on the trade surplus are going to gradually diminish because domestic consumption is going to rise as a share of their GDP. They also have structural imbalances in their own economy, which they know they need to address. And one of the biggest imbalances is they're very export dependent as an economy. And I think with the rise in their own household income and their own policies, they're trying to address that by pushing up the rate of consumption in GDP. The share of consumption in GDP is very low right now. So I think over time we will see the imbalances being addressed, but it's not going to be overnight. And in the meantime, I think they'll still continue to be investors in U.S. Treasuries. I don't think we'll see a big shift away from that because in the end, the U.S. Treasury market's the deepest and most liquid, and there really isn't a substitute right now. The Euro debt market could have been, but given the problems in not only in the debt market in Europe, but also with the outlook for the Euro itself, that's even a bleaker prospect than investing in U.S. Treasuries right now.
Richard Eskow, what would you like to see China do? I'll come back to you in a second, Andrew. I just want to ask Richard very briefly what he feels China should do, if anything.
In terms of U.S.
policy,
or in terms
of trying to stabilize the global economy or make a contribution to that stability?
Well, I think the main thing that China can do right now is offer a little bit more than scolding to the United States and suggest a path forward that it would endorse of rationalizing the revenues in this country with expenditures a little more and understanding what we need to do in this country to get the economy moving. I don't expect that, but that'd be ideal.
All right. Andrew, briefly.
So rather than telling us to raise taxes, what China should do is allow its currency to rise. That will fix all the imbalances that we were talking about earlier. By allowing their yuan to appreciate, that will spur domestic spending, that would slow down their exports, that would increase their standards of living. Of course, China has been supporting the world by flooding it with cheap goods, which is a good thing for consumers around the world. But if China does let its currency appreciate, which solves a lot of its problems, that does mean that the United States in particular will have a lower standard of living as all the goods that we currently import from China become more expensive in dollar terms.
Rajiv, you mentioned Europe.
We are seeing that happening.
Yeah, well, I want to turn to Europe because we're running out of time.
I just wanted to say that on the...
Rajiv, we must move on to...
We must more robustness would be
more
nice.
Robustness, yeah, we heard about robustness, but in Europe there's panic, there's contagion there, most certainly. Is Europe capable of putting its economic house in order?
Well, I think it's a much more difficult problem than in the US because you've got so many governments and, 27 different governments disagreeing with each other on how to do it. I think what we have seen in the last few days has been positive, that the ECB has been acting to buy into the Italian and Spanish bond market and reduce some of the contagion by driving down the bond yields for both those big EU economies. So I think that's been helpful. But in the medium-term outlook, I think this is the biggest risk to the global economy, that there's a lot of deep-seated problems with the sovereign debt crisis that we're seeing in Europe. And in the end, they have really gone very far in raising their government debt levels, and we need to see fiscal austerity for years to come. We need to see bank balance sheets deleveraging in Europe again for years to come. And this means that the European growth outlook is going to be very weak. So I think the outlook for Europe is a very poor, and I think it's because of that, it's one of the greatest risks to the global economic outlook right now. More so than in the U.S.
More so than the U.S., Richard Eskow? A greater risk, Europe?
Well, I think there is great risk there. I think one thing Europe's done a little bit right is it's been a little bit more aggressive than the U.S. in trying to rein in some of the banking abuses, and I think that will serve to its benefit. But I would agree that what you have in Europe are separate political powers that won't cooperate with one another, leading to paralysis around a linked currency. In that sense, it's very much like the United States, by the way. And so I do think there's real reason for concern in Europe because of that.
I think a dissolution of the Eurozone is a distinct possibility. You are seeing the limitations of their political and economic union that certainly don't go hand in hand. But I think if we do see a dissolution or a partial dissolution of the Eurozone, it's not going to be a disaster. I mean, you'll still have, if Germany were allowed to go its separate way and be an independent country, it could provide. It's large enough and powerful enough to provide that safe haven that a lot of people are looking for. So I don't see it as a complete disaster. It's certainly a long transition for Europe. Their problems, debt-wise, especially among the northern tier of Europe, are not as intransigent as they are in the United States.
The market roller coaster looks set to run and run as Europe and America come under increasing pressure to deal with their high levels of debt and stave off another recession. The outlook is extraordinarily uncertain. Thanks to our guests, Richard Eskow in Los Angeles, Andrew Schiff in New York, and Rajiv Biswas in Singapore. And thank you so much for joining us here on this edition of Inside Story. We welcome your comments and suggestions. Please email them to us at insidestory@aljazeera.net. From me, Stephen Cole, goodbye.